Welcome to episode 42 of Fundraising Demystified. Today, we have a unique guest on the show with us, Peter Goldstein, the author of The Entrepreneur's IPO, an expert in taking micro cap and small cap companies public. If you want to learn what it takes to go public, then this episode is for you. Peter is the CEO of Exchange Listing, a firm helping micro and small cap companies go public. If your company is valued at $50 million or more, this episode will be an eye-opening experience for you to discover that venture capital and private equity isn't your only option. Peter's experience started as a founder with multiple exits and IPOs, leading him to work with other founders to help them pursue listing on major exchanges to create liquidity and growth capital. Peter and I dive into the details of going public. This episode is a mini master's class, and you're going to love it. Now, if you want to get updates on our weekly podcast and newsletter, be sure to subscribe at join.thunder.vc. Again, that is join.thunder.vc. Now, on to the show. Hi, everyone. Welcome back to Fundraising Demystified. Today, we have Peter Goldstein with us, founder and managing director of Emmis Capital and CEO and founder of Exchange Listing. Welcome to the show, Peter.
Jason, great to be here. Thanks for having me. And I'm excited to have, a dynamic dialogue and share some great insights along the way.
No, I'm excited to have you on the show. This is a little bit different than our typical audience or typical guests that we have on. We're going to be diving into how companies can go public and kind of what you're doing to enable that. So, I'm excited to have you on the show. So let's go ahead and jump right in. Peter, you're a capital allocator, you're an author, and you help companies go public. It's a pretty unique background. So can you give our audience a little bit about you and what your story is?
Yeah, I'll give you the shorter story. It goes back to, the childhood, newspaper route and raking lawns. And, I really believe like I have entrepreneurial DNA, built in me. I'm 60 now. I started my first company when I was 24, and I had my first exit at 30. And so really, for the last 35 years, I've been focused on building companies. It's where my passion lies. And specifically, I would say in the last 20 years, my niche is oriented around the capital markets and working with small and micro cap companies that are either wanting to be public for the first time through an IPO or are existing public company that are undervalued and haven't gotten all the benefits out of being a public company. So my journey has been quite unique in the sense that one kind of opportunity led to the next. I have, been a founder, taken two of my own companies public. I've been an investment banker. I started my own investment bank from scratch, was fully licensed, sold that, and then really have created Exchange Listing and Emmis to serve in this niche that is greatly underserved and quite honestly is misunderstood by many people around what's possible for emerging growth companies to utilize and access public capital and liquidity in the capital markets.
Okay, this is going to be a fun conversation. I have so many questions. So let's kind of start back at kind of your role in taking companies public. One, your companies. So let's maybe start there. Like, tell us a little bit about that history and what that experience was like in terms of building a company that was ready to go public. What was that like?
Before I took my own companies public, I worked as an advisor on several microcap companies that had approached me. I was working with them on more traditional scaling, business operations and business systems. And one of them, we were doing some M&A work, asked me to help assist with their going public. And I knew nothing about the process. They trusted me and asked me to look into and educate myself and educate them. And so I cut my teeth back. This is probably 5 years ago now, Jason, on doing a reverse merger with a private company and a public company, which in Canada and the US throughout the years has been a one way for a company in the micro and small cap space to get the access to being a capital market, publicly based company. And along the way, I realized that there's a lot of great opportunities for small to micro-sized cap companies to be able to access capital and liquidity that wasn't really fully served by investment bankers. So, it's very hard to find a banker that will recognize, the companies of this size. More importantly, what I learned was that the ability to grow your business when private into maturing into a public company, takes time and planning and takes resources. I didn't have a lot of that knowledge when I took my first companies public. My first one was on the OTC markets. My second one went on to NASDAQ. So, as a principal and a founder, I made all kinds of mistakes, learned all kinds of lessons, which I now obviously want to bring to the entrepreneurs that I work with and to the audience, and to be able to educate those that really are wanting to and committed to pursuing the path of being public.
So let's start with some education. Walk our audience through the difference of the OTC and listing on OTC versus listing on NASDAQ.
So we focus now on NASDAQ, New York Stock Exchange, and actually the CBOE, which is the Chicago board, which are all senior listed exchanges. There was a time where the OTC markets were much more vibrant for earlier stage companies, kind of to be able to develop and mature as a public company and be able to access capital and liquidity. Unfortunately, a lot of that has dried up. So now we're really focused on getting to a senior exchange, because that's where the benefits come on being able to access institutional capital, being able to have the benefits of liquidity, and the combination of those are really now where we would work with any company that would want to go public, and meeting those listing criteria, which are much more rigorous than it would be on the OTC markets.
Gotcha. And let's just talk about that a little bit more. So you're basically saying OTC is not what it used to be, and correct me if I'm wrong, my terminology is wrong, but trading pink sheets is not the thing anymore. Kind of trading these like super micro cap stocks. Is that something you're just not seeing activity in like they used to, or what's kind of your take on that market? And
yeah, Jason, it's a viable option, but there's just not a lot of liquidity there. A lot of the institutional investors have mandates that they need the companies to be on a senior exchange, because of the compliance, the regulatory, the transparency, the reporting. So there's just much less capital and therefore much less liquidity than there used to be. There are still a number of really great companies that are listed on the OTC markets, just like there are in the CSE and the ASX and other kind of junior, I'm going to call them exchanges for this conversation, but they don't get all the benefits of being public. So we actually work with companies that are in similar situations that are ready to, I'm going to say, graduate to a senior exchange. But yet if somebody was initially wanting to go public now in this market, in this time, I would only be recommending a senior exchange listing.
Gotcha. And what are some of those benefits of going to a senior exchange?
You can take the obvious ones, right, of access to capital and liquidity. And I'll start with the capital, because I think it's really greatly misunderstood, Jason, that a micro and small cap company, meaning you don't have to be a unicorn in order to access institutional capital. There are a number of investors that focus on emerging growth companies, the future stars, right? They have to start somewhere. And as an alternative to venture capital, as an alternative to private equity, there is capital, albeit expensive, just like anything else these days, that is formed to be able to invest in companies that have liquidity events. And then, of course, the value that I believe is much greater to the companies at earlier stage is the benefit of the structures and the transparency that are required to meet the listing metrics. Meaning, if you can operate your company as if you were already public and then an existing public company, it comes with much greater transparency, oversight, systems, controls that really benefit the entire organization and all of the stakeholders that are a part of it.
What are some of those criteria? Like what kind of what stage does a company need to be at before they would even start considering this process of going public at the scale that you're talking about?
Yeah, so let's frame it, Jason. So there's small cap and micro cap, right? Small cap really starts $300 million market cap or above. Let's take it up to $1 billion. That's a very wide range. That's a wide berth of companies, right? And then micro cap would be 50 million to 300 million. right? There are nano cap, but they don't really fit this conversation. That would be more of the OTC or earlier other platforms. So where we're looking at micro cap companies, that definition of $50 million market cap, which is simply defined as, your price per share times the number of shares that you have issued and outstanding to give you an overall market capitalization.
Yeah, and when you're coming from the private markets, which most of our audience is coming from, venture backed or private equity backed companies, they think of, hey, I'm raising $10 million, giving up 20% of my company. We're a $50 million market, we're valued at $50 million. Is that's not necessarily equivalent in this case, correct? Like what's kind of the underwriting that's required, and like what kind of revenue are these companies at that would typically fit the criteria to go public on these kind of the micro cap numbers or small cap?
It is actually similar in the beginning, Jason. It changes over time because then there's a mark to market on your stock. One of the pitfalls of being public is that that's a volatile market cap, right? Especially in this market, stocks are opening up below issue,
Sure.
but they start off with that same formula.
Okay.
With a valuation, and that valuation is typically entered into with the help of the investment bank, of course, with comparable companies and comparable, valuations that are defensible, but really it gets set initially by the investors that are participating in the IPO. So as much as every entrepreneur I know, including me, when I took my companies, we think all of our babies are perfect and they're absolutely beautiful, and therefore they should be getting the ideal premium. It's just really between the investors negotiating, and that's where the old auction came from, right? In the IPO process, where it's going to be dependent upon the market. And that is something that happens dynamically at the time companies are ready to go. And now, of course, companies can test the waters. There are a lot of tools they can utilize to determine if the market is going to be receptive and it will meet their valuation. In this environment, down rounds are happening on a fairly regular basis, meaning that, the private or last round that was done would be, at a higher rate than the current round is being done to access more capital and potentially even to access liquidity.
So for a lot of companies out there, they're dealing with that exact problem: down rounds or some pretty aggressive liquidation preferences, or, preferred shares that have certain, premium rights over, the common. Is this a way or an option for companies to maybe eliminate some of that baggage on their cap table by going public?
It is, depending on those nuances, Jason, right? Like every, I want to do the blanket disclaimer that that's specific to the type of structure, right? And the criteria of their prior capital rounds, which we'll talk about probably later, about some of the better practices to be leading up to, a public liquidity event. But it is an option, and often there are conversions of those preferred shares and or debt that can come along with a liquidity event. So the balance sheet can often get cleaned up significantly, and you have access to new and fresh capital. And typically, what we're seeing, especially now more these days, are where the pockets of venture capital or private equity that the companies had utilized before are no longer available to continue to invest, either at the same level or even lower. So there is more optionality. And I think the message I want to give, you and to the listeners, is that there's much more access than people realize at the small and micro cap level, because most people are kind of ingrained in the fact that, oh, you have to be a unicorn, VC backed with 100 million in revenue, 15 to 20% EBITDA, 30% growth. That's just not true. Those are myths that got created on Wall Street, largely driven by, the dot-com bust, where, it was seen that if you're too small and too early, you're too high of a risk. Well, 25 years later, a lot of those myths still remain. And I'm here to tell you that, that's just not reality.
So let's talk a little bit about your firm, both the capital allocation firm, the fund, as well as exchange listing, your firm that helps companies go public. Tell us a little bit about what you're doing at these firms to kind of help companies navigate these options.
So I'll start with exchange listing because that's the advisory side. And it's really the heart of our business. We look at, especially in this market, that you want to take 12, 18, maybe even 24 months before you're ready to be public, to get prepared, to be educated. So if you're a large cap or a mid cap, you're going to go to Deloitte, you're going to go to a McKinsey, right? You're going to go to Accenture. If you're small cap and micro cap, there are not that many options. So I specifically created exchange listing to satisfy this need. And the need being, really interesting, dynamic, emerging growth companies whose management is committed to going public and needs someone to advise them through the entire landscape. So, of course, they could go to a banker, or they could go to a lawyer, or they could go to their accountants and auditors, but they don't necessarily have the entire ecosystem, nor do they have the time, the perspective to be able to work with the management team and all of their stakeholders and the board members to prepare them. So we have a wireframe that could take anywhere from 6, 12, 18 months to walk the companies through all the varied aspects and the dynamic nature of being prepared for and educated before you even begin executing. So in a perfect world, I would say to a company, take a year and start to develop your systems, your reporting, start drafting your SEC requirements, start building your board, right? Start operating inside of what it would be, just like going to the gym and flexing your muscles. You need to develop that over time. You don't just get, buff and ripped overnight. These are criteria, that over time will prepare you best for that eventual event. And that's our role. We then work directly with the exchanges. I talk regularly with NASDAQ, New York Stock Exchange American, the CBOE, in understanding when a company is ready to apply, what the process is, what's needed to satisfy the listing requirements, both quantitative and qualitative. We work within the investment banking community. We introduce our clients to select investment bankers looking to make that match, right, between the bank and more specifically the banker and the company who's going to be the champion of carrying that company to market. Same with the auditors, same with legal, really the entire ecosystem that I've been operating in for 20 years now as a resource to flatten the learning curve, the cost, and the timeline for companies to prepare to go public.
So I imagine, you've done this obviously a handful of times, not only for your own businesses, but for your clients that you've serviced. What are some interesting stories you've kind of been through dealing with helping these companies, go public? Like, what are some of the horror stories and what are some of the success stories that, really shaped your business?
There's so many, Jason. Every time I think I've seen it all, right? Like I'm 60, I've been doing this for a long time. And that's part of what I love about what I do. Because just like the markets are dynamic, as is the process of taking a company public. The crescendo, right? That kind of beautiful moment of going to a bell ringing is really just a phenomenal event where all the hard work comes together in a moment of celebration. I had the benefit a few weeks ago of going to the Chicago Board of Exchange, which just began listing companies. They've been, historically futures, commodities, and in trading ETFs. So we did the first actual issuer IPO at the CBOE. And so I got to basically participate in that bell ringing event with the company, which is an AI company. And it really is a very rewarding work after that was about 2 years of volatility in the market and being able to overcome challenges to be able to actually access capital for the company to successfully list and trade. I could talk to you for days about the war stories, my own included. I think I made so many mistakes because I didn't have guidance and I didn't
what
know
would be
better.
Just out of curiosity, what would be one of those mistakes?
I'll give you the classic. So when we filed when I took my first company public, I didn't know the difference between how to interact with the lawyers and with the Securities Exchange Commission. And I had a young lawyer who I still work with now 25 years later. And we were so focused on diligently addressing every question that came to us from the SEC. and exchange, because it's a dialogue. The SEC asks you questions, they provide comments, and you provide a response. And I went on for 13 months discussing certain things in dialogue with the SEC that really could have very easily been answered without challenging and trying to prove a position of fighting over dotting an I and crossing a T, right? So, young, early stage, kind of didn't have the big perspective. And what should have taken 6 months ended up taking, 13 to 14 months as an example. And those are hidden costs inside of going public. If you're spending twice as long in a review process, paying for legal, it's restricting you from being able to enter into accessing capital and liquidity. So that's just one that comes to mind of an early learning ground. Now, as I do this, first of all, we have the knowledge base where we write the SEC perspective in conjunction with the lawyers. So the lawyers do the legal component, risk factors, all the disclaimers, all the national, right? We focus on the company's message and the company's particular position and value proposition, because that's a historical document when you write an S1. It's something that's a legacy document that lives for the lifetime of the public company. And with inside of that, if the SEC comes back and says, we'd like you to reposition this language or that language, now we work with them and we complete that. And then we move on to the next task, as opposed to taking, extended periods of time to prove the point that we want to dot the I and cross the T. So there's many. The biggest mistake I think that company entrepreneurs make when they're taking their companies public is that they underestimate the amount of hard work that it takes, not just to get there, Jason, but then you first have to then begin operating as a public company. And you're under almost immediately an immense amount of pressure. And now you're operating a second business line, which is managing the public side while you're still responsible for managing the operational side of your business.
Yeah, that's an important component that I imagine is a bit of a shell shock for founders once they get to that point. What's something where you had a situation where you kind of go in, everyone's kind of got their expectation of like, here's the goalpost, and maybe you ring the bell, maybe you don't ring the bell, but like, what is something where you just got completely derailed, or something that was just such a shock to the plan? What was the situation where that happened?
Well, if I think about recent ones, it's where there have been assumptions made in the financial projections. And this is great learning ground. It's a great question. So many entrepreneurs are forward looking, and based upon their own experience and their belief and their set of that entrepreneurial kind of grit that they believe they're going to be able to go out and produce a certain amount of revenue or produce a certain amount of contracts. More than often in this environment, those things take longer, cost more. And where I now look really with, the very fundamentals of testing out an early stage growth company's assumptions for their revenue and everything that goes into the financial modeling. And in recent, I will tell you that there have been really superb management companies that were VC backed, that had great projections. Their assumptions didn't hold up, and it really caused significant setbacks when investors realize that what the company has been projecting, and that would be the basis of their valuation and the return on their investment, isn't valid.
That's harsh. That's a harsh reality.
It is.
So we talked a little bit of the doom and gloom or the tough stuff. Let's talk about some of the positives. So company decides to work with you, or in general, pursue the going a public. And what's the situation like? What happens? Okay, you get to that point, you ring the bell, you have all these responsibilities of running a public company, but what are some of the positives beyond just access to more capital? Because you can raise money in various different ways once it's public. But like, what are some of the net positives that maybe aren't as obvious that have occurred for some of the companies you've worked with?
I think there are two that come to mind, Jason. One is the ability to use your stock to attract management, right? Inside of employee stock option plans, to attract human resources. We're all struggling to find the best people that we can to work for our organizations, to grow and scale our organizations. One of the great ways to be able to do that is to motivate and reward them with another currency, outside of, their cash compensation. And then I take that further, where you could use that same stock and that currency to go out towards strategic partnerships, right? To go out towards M&A opportunities, to be able to make acquisitions utilizing your stock as another currency. And that leads to what I think was one of the undervalued benefits of going public, which is the credibility that your brand gets. So we also work with a lot of foreign issuers, Jason, who want to come to the United States, one, because of the capital markets and access to capital, but also to bring visibility to their product, their service, or their technology when they want to scale and grow. And you don't need to be foreign in order to benefit from that. Think about the value that you're getting of ringing a bell. And whether it's NASDAQ, New York Stock Exchange, just the footage, the coverage, the exposure that gives to your brand, millions and millions of dollars worth of value that you're not paying for directly, right? It's an indirect benefit. And then, of course, because now you have proper governance, you've met all the listing criteria, any particular, I would say, future business opportunities, you're overcoming such hurdles that other small to medium-sized companies might otherwise have a challenge overcoming.
And as you're sharing this, something that just always kind of sticks with me is, it's become more and more commonplace in terms of topic. It gets brought up, like companies are staying private longer. You go to the 80s, 90s, and up until basically the bubble, everyone was going public super early. Early compared to what they are now. Now companies are waiting to be $1 billion in revenue before they go public. Why do you think they're waiting so long, especially when we're in such a dry market right now? Like, everyone's starving for liquidity. There seems to be so many benefits to going public. Obviously, there's market hesitancies. Oh, they're going to drop at going public or whatever. But there just seems to be so many net benefits. Why are investors and founders wanting to stay private longer?
Yeah, it's a great conversation. I don't think there's any one particular, specific issue. I think it's a whole host of issues that are often very specific to the company itself, or also to the financial backers, to the VCs or the private equity investors. And I think largely, the answer lies in economics right now. Unfortunately, many issuers who have done their IPOs open up slightly above and then dip below their issue price. And that penalizes shareholders. So on the one side, you have access to capital and liquidity. The other side, there's downward pressure. And I think that downward pressure, the cost of going public, the pressure, the negative potential impact on your price of your stock are very practical reasons why one would not want to consider doing that in this environment, or quite honestly, in any environment. It's just now more so than ever, Jason, there's just tremendous pressure. There's a lack of quality capital, whether it's VC, PE, or the institutional side. It's across the board, right? There's more money in the sidelines now in every one of these areas than there has been, maybe in our history, right? So for those companies that are going public, there's an extra component of downward pressure, and a lot of the money is fast money, right? The prior round of capital may be locked up. The new round of capital is in a superior position, and often they're looking to get liquidity out as quickly as possible. And that puts, a very kind of challenging position for companies when they're also under pressure to be able to perform, hit their growth numbers, hit their milestones, and manage, these kind of negative pressure of being public.
So my oversimplification of that is private investors have kind of overinflated some of these investments that they've made to the point where the company hasn't yet grown into the valuation that the public markets respect or, would value. And so therefore there is that immediate down pressure to go public, kind of forcing these companies in this kind of conundrum of staying in the status quo, knowing that if they go public, there will be, some carnage to kind of face given that they benefited from the overvaluations in the private markets over the last several years. At least that's my interpretation. It might be what's going on and what's withholding people from jumping into what could be a much more positive situation for their company.
Yeah, it's an important aspect, and I agree with you in the sense that the valuations had gotten so high and so overinflated, and then there has to be, if you're going to go out for another round, there's going to be potentially an adjustment, but more importantly, the market's going to seek its own level. And then if you add in the complexity of shorting and naked shorting and machine trading, you're exposed. Where if you stay private, you don't have as much exposure, you don't have as many variables, as long as you can access the capital. Then, and as you look at it now, as I see the IPO market, there's a pipeline of companies that are waiting.
Yep.
And this is really one of my messages to your listeners for anybody who's considering going public. Get ready now. Be prepared. It takes 6, 9, 12 months to be ready, right? When the window opens here, which we know it will, Jason, it's just a matter of time. You want to be in a position to take a shot on goal and score.
Yeah.
And if you're flat-footed, and whether that's in your private equity side or the VC or in your pathway to a liquidity event, you could potentially miss the window. So I'm a very big advocate for management to start now and use the time to prepare. And even if you never go public, your organization will benefit greatly from the practices you put into place. And that's why I wrote the book that I wrote. I want companies to understand the practical nature and the benefits of being prepared and organized for an eventual liquidity event.
So I want to kind of get into what type of companies, you're looking for and think should pursue this option and start the process of getting ready. But before I do, I want to talk about kind of what happens to those early investors, after the situation we just talked about, and say this window does open, people start, going public. Those earlier investors that, called the angels, the pre-seed, the seed round investors that got in real early, they're kind of at the bottom of the pref stack. They, as you say, they're kind of locked up. They have no control, very little influence. The company goes public. Most everyone's going to get converted to common in most cases, correct? Multiple
Correct.
share classes are pretty rare. What do you see typically happening to these earlier investors that have been locked up for 5, 10, 15 years in comparison to those, as you say, fast money investors who come in last, top of the prep stack, and want to get out fast?
Yeah, it's one of the dynamics, Jason, of the capital markets, and that last money in gets to kind of call the shots. So what we see for the shareholders that are the legacy and the historical shareholders, maximum is a 1-year hold. Depends on the underwriter and how many shareholders and what the diversity is in the cap table, to 6 months, to in some cases could be 3 months. It's on a case-by-case situation. 6 months would be kind of more of the sweet spot. And that's why when you see IPOs come out, there's often a window of being able to see what happens in the 6 months when those lockups come off, because then there's more sellers that come into the market. And that's where, you can see stocks get again under pressure, where there's more selling than there is buying. So, a lot of investors look specifically for those time frames and to be able to see where they fit. For the shareholders that got in early, once that lockup is taken off, then they're in a position to be able to sell. And so, again, my practical advice for those investors is get all the paperwork and all the documentation that you need to be ready. So then when the lockup comes off, you're in a position to liquidate should you want to. And I think it's really important to understand and follow the company. If you've been a shareholder for that long of a period, understand how the company's performing, what the key metrics are, follow them, track them, and don't be in a quick rush to want to sell just because of liquidity. You believed in the company back then. Take a look and understand where the company is going. Are they on track to meet the growth milestones, which would ultimately increase the ROI for you as a shareholder? Being locked up is not necessarily a bad thing. I know there's a negative connotation to it, but it happens with me all the time. And if I believe in the company from day one, then I believe in it 6 months later, 12 months later, as long as that management has continued to perform the way that they have when you bought into the company back in its early stages.
Good advice. So let's talk about the types of companies that you think are a good fit, not just for, your services and what you do at Exchange Listing, but are, a good opportunity at that kind of micro cap, small cap range to go public. What are you looking for in those companies?
It's a little cliche, Jason, but it starts with the jockeys. We're betting on management. When you have an early stage company, whether it's outstanding technology, service, product, they're all going to demonstrate similar characteristics of that ultimate hockey stick growth and the ability to grow exponentially and build and provide an ROI. And you can get anywhere from a 2 to a 10 bagger. That's kind of the everyone's looking for the same thing. We start with management and then the fundamentals, because we know that in earlier stage companies, things go wrong. Markets change, industries change. There's issues that they can control and those that they can't. We're just coming out of, just take COVID. It's like, it had completely reshaped, the face of what it could be for a trajectory for a company for both good and bad. So if you're focused on the management and you believe in the management and then build in the controls and the systems and the structures to support their growth track, knowing that that may change, that they may take on variables, that's what we look for. And obviously there are hot sectors. We just did an AI deal. We're looking at consumer product. We're looking at tech. We're very big on life science, and medical device happens to be an area I personally am interested in, companies that are doing good in the world and are also ability, capitalist, right, for profit and for, kind of social good. So, I'm a capitalist, and I believe me, I'm all about making money. But at this stage, it's the combination of those two that really get me motivated, to work with dynamic entrepreneurs, visionaries who have taken their company to a certain level and are ready to get into, the next level of growth with a catalytic event. And I see what we do, Emmis, our fund, we consider it a catalyst. And that catalyst is to be able to give sometimes, what I would call special situation capital. Could be last mile capital, but it's critical to be able to get to the next event. And so we invest as well in companies that we see with the right positioning and the right capital behind them can make some exponential growth, with that catalyst being both the capital and the trajectory to lead them on to the senior exchange market.
No, it's great to hear. Just to, put it, clear to the audience, like you kind of give like, okay, sector and, but like what milestones these companies need to be at, like for the companies that you're working with, are they doing, 5 million revenue, 50 million in revenue, 100 million in revenue? Does revenue even matter to you? Like what other kind of KPIs matter to you when it comes to, working with these companies and getting them ready to go public?
So we've done 5, we've done 50, we've done 100 million in revenue. So, and we've done pre-revenue. Those are typically life science oriented, Jason, right? So med tech, life science, where, they're developing their pathway to revenue. For us, it's really about market capitalization. Do they fit inside of a capital structure? And do they have enough traction in the market? So I don't focus on revenue, focus on the overall value of the company as it stands today and where that value could be 12, 18, 24, 36 months down the road. And then it's really from there, what we do is we reverse engineer the requirements to meet an exchange. So if we have bought into the company and we believe that this is the right candidate and they are committed, and I emphasize committed because this is not for the faint of heart, right? You really have to be committed to want to go down this pathway. Then we partner with them. And I take equity positions in these companies as a way of showing that we're really partnering. It's not a transaction for me. In a sense, I'm a portfolio investor in what we do with our companies, both with capital and with services.
Okay, so that helps kind of clarify quite a bit in terms of where companies might fall in line and in terms of pursuing this. But from a expense perspective, like let's just say like a consumer brand doing 20 something million a year in revenue, maybe markets are giving that 1 to 3x, maybe 4x multiple. Maybe that's somewhere in the range of a micro cap. But it's going to cost money to play this game. It's not going to be something that, they can just show up and, get prepared, do all the necessary prep, and then, actually run the process, pay for all the legal, investment bankers, all that kind of stuff. Like what kind of cost go into this process from a company's perspective?
So there's a range, Jason, based upon, the depth and the complexity of the company. And in what status are their financials, their audits, have they been audited, financial reviews, so on and so on, subsidiaries, there's legal structure, right? So there are a lot of variables that go into that, but I can give you a range. A range would be probably $500,000 to $1 million with the way that we structure this, because we're very frugal and be very careful about the utilization of capital towards the cost of going public. Right. And then there's a different carrying cost once you're a public company, which could be $1 million to even $2 million a year, depending again on size, complexity. You have D&O insurance, reporting costs, audits, legal. There's a whole extra burden. So that's part of the decision making of, is the reward of going public big enough to want to go through? And that's where our fund, so at Emmis Capital, we actually provide capital to cover those costs of going public, because many of these companies at that stage of inflection don't want to take capital away from their operations. They want to put everything they have into growing their business. And I support that wholeheartedly. So how do you then prepare and how do you build that bridge? And that's where this last mile capital that we provide. And then we bring in strategic partners in the way of legal, investment banking, that are going to minimize the costs on the front end and be committed to the outcome on the back end. So you have to be prepared to spend money. There is access in unique cases to capital that can help to cover those costs. But if the company is well capitalized, I would put together a budget of $500,000 to $1 million to get you through the preparation, the execution and leading towards. I advise everybody to have two things when they go their process: a healthy balance sheet and access to their own capital to bring to the IPO.
Gotcha. So they need to be bringing capital to the table for the IPO. They got to have some investors already teed up on those relationships, already ready to go before, coming to this process.
Yeah, mistake 101 that I made, where I counted on the fact that the investment bankers, even though I used to be one of them, would be bringing all the capital. In this market especially, Jason, the more capital and more support that the company brings, issuer, right, stakeholders, additional capital, the stronger they go into an IPO. And there are some bankers that will actually almost mandate that from the company, in order to be able to take on and have a successful event, because demand for a new issue can change. But if you have existing supporters and you have existing capital and new capital that's coming along with you, it's a very simple adage, right? You're coming in strong as opposed to coming in, in a weaker position than one would be ideal in this kind of marketplace.
I'm so glad you mentioned that part, because I have a feeling there's a lot of people listening saying like, this is my shot to bring in new capital. And then pull the rug out. At least they see it before it happens, and they know they got to come prepared. And they got to keep those relationships, maintain those relationships, but like those relationships might be there. They're just not interested in investing as a private option, but as a public option, they would be. And so that it could at least create a more fruitful conversation for other investors. But I think that's an important kind of caveat that you mentioned for founders to be aware of.
Yeah, I think it's critical, Jason, like lessons learned, right? So pro tip is maintain a very close relationship with your existing shareholders. Constantly be building relationships with potential new shareholders. And more importantly to me is, understand that this is a dynamic nature, whether you're private or you're public. You cannot have enough support from a shareholder base. Communicate with them regularly, keep them updated, share the wins and the losses. None of us as CEOs are perfect. We all make blunders and mistakes. Own them, communicate regularly, build that support. And the stronger you have that relationship with your shareholders, the more sticky they are. And I think that that's something that, many CEOs going into the public, markets and the IPO don't understand, and they don't necessarily even get to know the new investors. And I think it's critical when you're on a roadshow and you're interviewing investors, they're interviewing you, get to know them. Make sure that you have a good sense of who's going to be on your cap structure and in your cap table leading into the event itself, and then manage your shareholder list thereafter with an understanding that your goal is to build the broadest, most dynamic shareholder base you can as a public CEO.
That is some incredible parting advice for our audience to be aware of, and to start work, maintain those relationships as early as now, seed stage and on, and, never let those kind of fall apart or falter, and kind of maintain those relationships, because that's also set the precedent for when you are, public and running a real IR process. So I appreciate you sharing those insights. Peter, where can people learn more about you, your book, and your firms?
Easiest thing is just go to LinkedIn. I'm very active on LinkedIn. I like to give away a lot of content and value and information. It's part of how I've built a real strong network around me. So just look me up on LinkedIn, and it's got information both about exchange listing and Emmis Capital. We're about to invite new accredited investors to Emmis Capital, so people can take a look at that. We did a founders round with phenomenal returns. So I'm excited to be able to expand our base of accredited investors. And if you're interested in the dialogue with me, just send me a direct message. I'd be happy to connect with you.
Awesome. And any final words you want to share before we wrap up today?
I think, you and I are aligned in wanting to bring knowledge and education and insight to the entrepreneurial community, when it comes to accessing different forms of capital and growing companies. That's a kindred spirit amongst fellow entrepreneurs. So it's been great chatting with you. I hope it brought value to the listeners, and I look forward to, ongoing conversation.
Awesome. I'm sure people loved it, and, look forward to people starting to reach out to you through the podcast, and, being able to take lessons learned from what you shared today.
Great stuff. Thanks, Jason.
Thanks for listening to the show today. We hope you learned something valuable, and if you did, be sure to let us know in the comments or by hitting that like button. And if you're a founder looking to raise capital, then join us at Thunder.vc. We provide a free tool to help you identify which VC, family offices, or lenders are the best fit for you using our AI. It will save you a ton of time from chasing the wrong investors. And since launching our free tools, founders that have joined our network have gone on to raise over $1 billion in financing. Again, you can find these free tools at Thunder.vc. And as a reminder, we release new episodes every week, so stay informed by subscribing to our newsletter at join.thunder.vc. Again, that's join.thunder.vc. And if you or someone you know has recently raised a round and want to share your story, please email me at jason@thunder.vc. And that's our show. We hope you enjoyed it, and we see you next week.